Welcome back. My name is Arya, and I don't waste your time, so let's get straight into it. Just as a heads up, I'm playing you a clip from my Patreon, which it's price locked at $3 forever if you're interested in that. And then we're going to circle back. We're going to talk about actually the valuation of it and that type of stuff, why it's kind of not sustainable. So I'll play you the clip and then we'll come right back. Buyback is a major value creation for slow growing companies. Dillard's is a slowing company, yet their stock has performed magnificently. AutoZone revenue goes slower than inflation, yet the stock price is going up every year. Long-winded way of asking if Apple can maintain share price. No, they can't. And yes, share buybacks are huge for slow growing companies. I'm going to add to that sentence, slow growing companies trading at cheap valuations. So if we go over to Apple, because what are buybacks ultimately, right? So in a perfect world, we can imagine that, Apple brings in, let's see, how much does Apple bring in terms of free cash flow? They bring in, Jesus, that's ugly. I actually didn't know that. Okay, anyways, Apple brings in about $100 billion of free cash flow per year. In a perfect world, they would, let's just say, allocate all of that free cash flow straight into buybacks, right? And what you have to note with that is those buybacks, they're buying back literally a piece of the company, right? So when you go over here and let's just toggle y-axis. Yeah, no, I'm just toggle that off for now. So, no, you know what? We're going to keep it on, but let's just make both of them a line chart, right? Okay, this hopefully makes sense. So they've been making about 100 billion in terms of free cash flow over the past like 4 years, right? And when you're making 100 billion of free cash flows per year and your stock is worth $2 trillion, you do 100 divided by 2 trillion, that comes out to about you're buying back about 4% of the company, right? And then over here, the stock's a little bit more expensive. It's like 3 trillion. You're buying back about 3% of the company. And so the way we actually measure this, we have it on FinChat. It's called buyback yield. So you toggle on the buyback yield, right? And so you could see that, as I said, they were buying back about 4% of the company in 2020, in 2021. They were buying back as much as 5% of the company, right? So just the pure buybacks is worth about 5% of the market cap, right? So that definitely supports the earnings per share and that type of stuff. In 2019 and early 2019, they were buying back as much as 10, 11% of the business. That is massive in terms of boosting the EPS, right? But if we kind of zoom it in for the past couple years, you'll see that this has consistently gone down. At the same time, what has consistently gone up? If you guessed the valuation of the company, you would 100% be correct. So, and you know what, we'll do price to free cash flow just to keep it even here and get rid of PE. So look, it's perfect correlation, right? When one of these goes down, the other one goes up. Same thing over here, like all the way down to these like tiny little trends. Like, look at this. Every tiny little movement up, every tiny little movement down is perfectly aligned. So they can keep buying back and is very accretive as long as your stock price stays cheap. Apple is definitely not a cheap business. They're trading at 37. At one point, they're trading at just shy of 40 times free cash flow. And so no matter what they do, because they don't ultimately have that big of a cash balance. Like they have, total cash, let's take a look, like 50, 60, 70 billion, whatever the case is, 50 billion. They have 50 billion of cash. So it's honestly, for a company that's worth 3.5 trillion, it's not that much cash. So they can't dip into the bank. They have a shit ton of debt. I think they have over 100 billion in terms of, about 84 billion of long-term debt. And then they have some leases and stuff, I'm sure, right? So they have a pretty big debt balance. They don't have much cash. And if they were to allocate 100% of free cash flow to buybacks, they only end up buying about 2.5, maybe 2.8% of the company. So that will not support a rising stock price. That will not support EPS growth. To be honest, it's not that much buybacks. And I don't know why people say Apple's this crazy buyback machine. I think Google literally buys back more than Apple right now, if we want to pull it up. Granted, Google does more in stock-based comp as well, but where's Google? Oh, it's actually exactly the same. This is so funny. So look at this, right? And let's bring this in a little bit. But yeah, like Google and Apple are doing the exact same amount in buybacks. But because, again, some of these YouTubers, for years and years, they've been like, oh, Apple's buyback program is so strong, whatever. It's fresh in people's mind. They don't actually look at the numbers like this to kind of realize like, oh, no, it was the case a couple years ago. Definitely not anymore. Apple does not have a strong buyback program anymore. Do you know who does have a strong buyback program? Booking.com. It's still at 4%. And I was looking at the stock in, fall of 2023. And at the time, they did have like a 9-10% buyback program. I was looking at this, I'm like, this doesn't even make sense. How is this possible, right? So, and this has gone down over time. But my God, back here, man, it was ridiculous. Welcome back. It's been 4 minutes for you, but 10 seconds for me. Anyways, with Apple, it's been a buyback story, right? So that has ultimately been the big sort of driving force behind the I wouldn't say revenue growth, but definitely the earnings per share growth over the past handful of years. And so like it's very, very obvious that, you know, you look at Apple, it's definitely a cyclical business over time. You have a couple years of sort of stagnation between 2015 to 2017 where the revenue does not move, followed by like a big expansion year, and then a couple years where it doesn't move, and then a big expansion year, right? So it like very easily you're able to kind of spot that within the revenue growth over time of this is a business that is very, very cyclical. Like that's quite obvious, right? And it shows in the growth rate, it shows in just looking at the revenue chart over time, right? Now, ultimately, that didn't matter much because if you toggle on the earnings per share, sure, the earnings per share kind of follows that over time, but it was like somewhat excused by the fact that like, you know, they have this very, very strong buyback program, and like they definitely did for a number of years. And then as I kind of pointed out in the video, actually, let's look at price to free cash flow over time. You know, over time, they've gone from a relatively inexpensive business trading at like 10, 15 times free cash flow to like, you know, the norm now has just been in like the mid 20s to maybe around like the 30 price to free cash flow range. And like really for Apple, this is like new heights in terms of valuation. This is never before seen levels of expensive for Apple. And like, yeah, you could maybe get a situation where it turns into like a Costco where it just like keeps going up and to the right, right? Jesus Christ, that's actually ridiculous. And maybe we should look at like, let's do forward PE. You look at Costco today, it's historically been a business that is trading, let's just call it around the 35, maybe 40 times forward PE range. So let's toggle this on. Yeah, so the 10-year median is at like 33, 34 times, right? So that's probably reasonable, even though it's like a slow growing business because it has a very wide moat. It's a very highly unique company in terms of retailers. Like it deserves to trade at a premium, right? At some points, it was trading at like a 44 PE in 2021, and that was expensive, just looking on the chart. And then now you've come into like never before seen levels of valuation. And like, dude, honestly, this can happen to Apple, right? Like we could be in this portion of things relative to where it is on the Apple chart, right? If we just toggle back on the Apple chart, maybe it also goes to like a 40, 50 PE, whatever the case is, right? You never know. The point is, currently you're invested in a business that because of the really high valuation, the thing that has kind of been the driving force behind at least not the revenue growth, but the earnings per share growth, the buybacks, they're becoming less and less effective over time. So I think, at least with Apple, there's probably this cap where at some point, like, it just doesn't even make sense for the multiple to keep expanding. You know what I mean? And so with that being said, to kind of put some numbers behind everything that's going on, I have what's called a CAGR calculator. And essentially what we're doing here is we're just kind of projecting out, we're just using some of today's numbers and we're kind of projecting out like, basically everything in the yellow. So your revenue growth, free cash flow margin, and the buybacks. And based off the estimates, what do we expect the sort of stock price return to be over the next handful of years? And so with Apple, I believe they've done about 100 billion in free cash flow, if I remember correctly. Let's search this up. Free cash flow margin. We also need, okay, it says about 25%. I'm going to just use this other number. So, okay, let's just say they done about 100 billion in free cash flow. They did 400 billion in revenues. And then let's just say by the year 2029, you know what, they do 30% in a little bit more, 32%. Let's try to be generous here, right? They do 32% free cash flow margin. I think they'll average about a 4% per year revenue growth. Let's just give them the benefit of the doubt. 3% buyback, right? And so today they trade at 37 times price of free cash flow, right? I'm just moving these around, by the way, just so we get sort of a better look. So here we go. So basically, if you're invested in Apple today, your future returns, and again, with like pretty generous sort of free cash flow projections, right? Like we're saying margins goes from like 6% to 32%. That is huge margin expansion. You're saying 4% revenue CAGR, which again, like pretty questionable. By the year 2029, you're still banking on the fact to have like 10-12% returns. You're still banking on the fact that the multiple stays at least 36 times price of free cash flow, right? And if it goes back to like, let's look at this. If it goes to something that like 20, okay, that's for the past 10 years, right? So let's zoom into for example, the past give or take 5 years. Still, over the past give or take 5 years, it's traded at 27 times free cash flow. So let's play that scenario. If it goes down to 27 times free cash flow, you're getting about 5% stock price CAGR over the next 5 years. So your returns in the S&P are going to be about 5% per year over the next 5 years. That's realistically what, like about 30-ish% total from here. So like, again, it just goes back to like thinking in bets of like, you know, if you see any sort of multiple compression, and again, this is on like pretty generous sort of estimates, right? Let's just say it's a little bit lower, all of a sudden your future expected returns go down a little bit more on top of that, right? Then actually you're banking on like continued multiple expansion in order for the stock to maintain a 11-12% CAGR, right? So like, again, it just kind of goes back to thinking in bets. The buybacks that has been a huge component of driving up higher and higher returns, it no longer is sort of that big share cannibal that it used to be. And then on top of that, like you're seeing growth kind of slip away from this company. There's talks about like having an upgrade cycle and that type of stuff. I believe they just dropped a discount iPhone model, but then it just goes back to like, ultimately at the end of the day, nothing really moves the needle for this company. And actually I could better demonstrate this to you guys this way. Nothing really moves the needle for this company because half of the revenues from the company comes from the iPhone alone. So they're like, with AirPods and all that type of stuff, like it literally, AirPods, as successful as they have been, they really don't move the needle for a company like Apple. 51% of revenues comes from iPhone, right? So it's still very much the iPhone story in terms of services growth. That's been good for the past handful of years, but even that has started to slow down in the recent quarter. I could showcase that to you guys as well. You can see like, services growth is kind of messy here. You can see services growth was very strong in past times, and now it's down to like a 14% growth rate year over year. But again, like you have, let's show this off as well, right? You have all of product as a whole. I'm not going to put every single revenue stream here, but you have all of products. So Mac, everything, iPhone, iPad, everything like that. That is growing at about 2% per year. And then you have services, which makes up 20% of revenues, growing at 14% per year. So like, does it really even matter at the end of the day? When you have 80% of the business basically not growing, does that other component of the business, does that really matter? You have like some of these revenue lines are just in decline. Like wearables as a whole is just in decline for the past, literally as far as I could see, right? Like, so Apple's in a tough place. I think it's going to look a lot more like Coca-Cola from here on out, as opposed to like a high-flying big tech company. It'll still exist. It'll still be like a big blue chip company, but the days of like hyper growth, I think, are far behind Apple. I could be wrong, right? So they could come out with a new iPhone and it's incredible, and they have all this innovation, and like this has happened over and over again. Of you literally could see it, the upgrade cycle, right? You could see it in the chart. Let's go back to it. Of this could be a prolonged sort of 4 or 5 year upgrade cycle for the company, and like maybe next year they'll do 500 billion in revenue because the next year's iPhone is just that much better. Remains to be seen. I'm personally not too optimistic, just because the past 5 iPhones have basically looked exactly the same, and like that's the cold hard truth. I don't care how much you love the ecosystem. I don't care that you've been invested in the company for 5, 6, 7 years and you're sitting on 300% of gains. The fact is, it's not the same company anymore. It's not. And I've been saying this for like a year and a half, but it only kind of became like a real narrative as soon as Buffett sells. I'm not taking credit saying like I predicted this. No, like a lot of people were saying and kind of pointing out the fact that Apple isn't growing. It's not like an original idea to me, but point still stands. This is a slower growing company. Anyways, thank you for watching. 2-week free trial for FinChat. Again, no card required for that. It's the top link in the description down below. And then additionally, if you like these type of clips, you could get more of those over on the Patreon. And I'm going to remind you, you get a free trial for that as well. And if you decide to subscribe, it's price locked at $3 forever. Thank you for watching and have a great day.